Hello everyone, Professor Christensen here. In this video, we're going to take a look at exchanges of non-monetary assets. So non-monetary assets are things like property, plant, and equipment. And the idea of non-monetary simply means that there is no dollar amount associated with that asset. So for example, an accounts receivable has a dollar amount associated with it. You know exactly how much that accounts receivable represents. Cash has a dollar amount associated with it, but a property, plant, and equipment asset does not have a particular dollar amount associated with it. So what we're going to be looking at is exchanging one asset for another asset. And this is no different than, let's say you have your old asset is an old car. And let's say your old car is worth $5,000. And you decide you're going to trade in your old car and you get a new car. And your new car is worth $25,000. So you're trading in $5,000 and you're getting a car worth $25,000. So what do you have to do? You have to pay the car dealer the balance, the $20,000. So the transactions we're looking at are very similar to that, except that when you're looking at property, plant, and equipment, remember we have accumulated depreciation. And also we're going to be dealing with gains and losses. Okay, so when you're talking about an exchange, the gain or loss is the difference between the fair value, so what the asset is worth today, and the book value. Now remember book value. Does everyone remember what book value is? Book value is the cost of the asset minus its accumulated depreciation up to the date of the exchange. Okay, so book value is cost minus accumulated depreciation. Okay, so we look at whether or not the particular exchange has commercial substance. Okay, so and we always remember that we always recognize loss. All right, so if you see that the book value is less than, the fair value is less than the book value, then you have to recognize a loss right away. All right. But if there's a gain, sometimes we're going to not recognize the gain and instead record a lower amount for our asset. Okay. So how do we define commercial substance? Well, if the cash flows in the future change as a result of the transaction. All right. Okay, so here we have a little flow chart, and the flow chart will help you. This is what you want to come back to when you're not sure whether you have to recognize a gain or not. Okay, and most of the examples we're going to look at today are very simple, but depending on what class you're in and what examples you're looking at and what level you're at, you might be needing to deal with some of the more complex situations. Okay, so the first question you need to ask yourself is there a gain or loss? That's number one. So you compare your book value to your fair value, and you decide, is there a gain or a loss? If there's a loss, you recognize it immediately. Okay? No questions asked. Loss, recognize the loss. Nothing else to look at. Now, if there's a gain, you have to ask yourself, is there commercial substance? If there is commercial substance, then you recognize the gain. Okay? If there is not commercial substance, then we get a little messy. Then we have to ask ourselves, was cash received? If cash was received, then we're going to defer part of the gain and recognize part of the gain. Okay? If cash was not received, then we just defer all of the gain. So we're not going to recognize any of the gain at all. All right. And this gets even a little bit more complicated, that if the cash that you got is greater than 25% of the fair value of the exchange, then we consider that to be a monetary exchange and the whole gain is recognized. All right. So those are all of our rules. We're mostly going to be looking at situations here in the commercial substance where we recognize the gain, and in the loss where we recognize a loss. Okay? All right, so let's look at some examples. Sorry, you're looking at my Camtasia. Okay, so here we go. We're going to look at, these are exercises from Spiceland if you happen to be using that textbook. Otherwise, you could just take a screenshot of this and follow it along. Okay, so our first example is trading in an older computer model for a new model. The old model's book value was $180,000. Fair value was $200,000. Okay, they paid $60,000 to complete the exchange, which has commercial substance. All right, now what is the first question we want to ask ourselves? Is there a gain or a loss? Okay, so book value is $180,000. Fair value is $200,000. So that means we have a gain, and our gain is $20,000. Okay, I'm going to just type that in here. Gain equals $200,000 minus $180,000, and that equals $20,000 gain. Okay, so our gain is $20,000. All right, so let's try to put together this journal entry. So the first thing is, what did Cedric pay for this new computer? Think about it. What did they pay? They paid $60,000 is what they gave in cash. But what else did they pay? Well, they gave up this computer that was worth $200,000. So the new, let's just call this new equipment. We're going to call it new equipment and old equipment just so we can differentiate them. The basis or the cost of the new equipment is $60,000 in cash plus $200,000 value of the old computer that we gave up. So we're going to debit our new computer for $260,000. Okay, so now let's decide what else we need to do here. So we already said that we have a gain. So we know that gains increase our equity. So we're going to say gain on sale, and we're going to credit our gain for $20,000. Remember that a gain increases equity like revenue does, so it has a credit balance, and a loss is going to have a debit balance. Okay? So what else do we need to do here? Well, we need to record the cash we paid. Let's do the easy stuff first. We know we paid cash of $60,000, so let's take that and credit the cash. Now, what else did we do? Well, we got rid of our old equipment that cost us $400,000 with $220,000 in accumulated depreciation. So we have to credit our old equipment because it's going away. We don't have it anymore, right? So we credit it to take it off of our books at original cost. Okay? Take that out at original cost. And what else do we have to take out? We have to take out the accumulated depreciation associated with the old equipment because it's not going to be there anymore. And we're going to debit that because that has a credit balance and we're getting rid of it. Okay? All right. So as always, add up your debits and your credits. We have 480 here. We have 480 there. Beautiful. Our entry is all set. Okay? So that is a case of a gain with commercial substance. All right. Let's look at the next one. We have 4 exercises here to take a look at. Okay, same facts, except that the fair value of the old equipment is $170,000. All right, so now we have a fair value is equal to 170, and then book value, let's go back and remind ourselves, the book value of this asset was 180. So what do we have? We have a loss. Okay. Whoops, loss. Loss on sale is equal to $10,000. Okay. All right, so remember what we said. When you have a loss, we don't care if there's commercial substance or not. You just record the loss right away. So let's just debit the loss right away for loss on sale. Loss on sale is $10,000. Okay, so now let's go back here. These two debits, this debit and credit, is always going to be the same if we're getting rid of this particular equipment. Why? Because we're getting rid of the equipment And we have to take the accumulated depreciation out also. So let's go back down here and let's debit the accumulated depreciation. Which was 220,000. And I always start my debits at the top and my credits at the bottom because we're not sure how many debits and credits we have, right? So we're going to credit our equipment with the original cost, which was 400,000. Okay, so now what else do we have? Well, we still have our cash, right? So we'll credit our cash, $60,000, loss on sale, and then we're going to debit our new equipment. Okay, so now in this case, how much are we going to record for our new equipment? We still paid $60,000. But what else did we give up? We gave up a computer that is worth $170,000, right? So the value of our new equipment, let's label these better. Let's call this new equipment. Let's call this old equipment to remember. So our new equipment is $230,000. Okay? All right. Again, you're going to add up your debits, 460,000, add up your credits, 460,000. All is well. All right, so let's look at a couple more examples. Now, I'm going to pause the video for a minute. I'm going to give you a couple minutes. See if you can record this non-monetary exchange. Now, this one's going to be a little bit easier because you're taking out land, and land doesn't have any depreciation, of course, associated with it, so that might be a little bit simpler. But let's see if you can answer these questions. So I'm going to pause the video, work on it, and then restart it. So you're going to pause the video and restart it as soon as you're ready. Okay, let's come back to this one. Hopefully you figured it out. We're kind of taking a little bit of a different approach here. But now we're exchanging the land for equipment. The land had a book value of $120,000 and a fair value of $150,000. So hopefully the first thing you thought to yourself was, we have a gain, right? Because fair value is greater than book value. So we have a gain. Let's just put that in here to remind ourselves. Gain on sale equals 150,000 minus 120,000, which is 30,000. So we're going to have a gain on sale of 30,000. Now, first question is, what is the fair value of the equipment? Well, we assume in an arm's length transaction, so that means this is not you selling something to your cousin and giving them a deal on it, right? This is two companies exchanging two assets. The values are equal. So how much must this equipment be worth? Well, the fair value of the equipment is equal to what we're paying for it. So what are we paying for it? We're paying $150,000 in fair value of the land, and we're also paying $10,000 in cash. So the fair value of the equipment must be $160,000. Okay? All right, so now we have everything we need to put this together. So now we're going to debit equipment for $160,000. What else do we know? Well, we know we're crediting cash for $10,000. We know we're crediting land because the land is being given up, and the land had a book value of $120,000. And then finally, we're going to credit gain. You could say gain on exchange or gain on sale or just gain. And our gain, we said, is $30,000. Okay? All right, so again, add up your credits. They total $160,000, and they're equal to our debits. All right, next up, one last exchange. So we're going to do the same thing that we just did, only in this case, we're assuming that we received $10,000 from the owner of the equipment to complete the exchange. Okay, so if we received $10,000 from the owner of the equipment, let's go back here to remind ourselves. Let's just take this, copy it, and put it down here so we have it in front of us. Okay, So we're receiving 10,000 from the owner. So what is the fair value of the equipment? All right, so the fair value of the equipment is the fair value of the land, right? Minus 10,000 in this case, right? Because what are we saying? That we got 10,000 from the owner of the equipment. So the equipment must be worth $10,000 less than the land. Okay? So the fair value of the equipment in this case, $140,000. All right. We still have the gain because we still have the difference between the fair value and the book value. Only now the cash is going to be coming in instead of going out. All right, so let's put this transaction together, put the journal entry together. But now we're going to debit equipment for 140,000. Make these red. All right, we're going to debit cash because we're getting cash in this case for 10,000. Okay. And what else? We know we have to credit the land because the land is going away. So let's credit the land for its original cost. Remember, whenever you get rid of an asset, make sure you take it out at its original cost. And finally, we still have the gain. And the gain is $30,000. Okay? Again, check your debits, 150. Check your credits, 150. And all is well. Okay, that is how you record the simplest of the non-monetary exchanges. I hope you find that helpful in your studies.